Most investors are worried about tariffs, but smart investors are actually profiting from them. So in this video, we'll break down 7 tariff-free stocks that are completely insulated from trade wars and global supply chain chaos. Most investors panic when they hear the word tariffs, and for good reason. Rising import taxes can squeeze profit margins, disrupt supply chains, and really send stock prices tumbling. So what makes a company tariff-proof? Well, we could start with this. First off, they don't rely on imported physical goods. If you're not moving products across borders, tariffs, they don't really touch you. And that's why software, subscription services, and domestic utilities, they kind of tend to fly under the radar during trade wars. Second, these businesses often operate mostly or entirely within the US. So there's no need to worry about, international shipping delays or price spikes on foreign materials, or even, getting tangled up in geopolitical tension. They make money from US customers using US infrastructure. And finally, a lot of them run on a recurring revenue model. Monthly subscriptions, long-term contracts, or essential services that people pay for no matter what the headlines say. That gives investors something rare in a shaky economy: consistency. So let's start by taking a look at one of the best examples out there. It's a business that you probably use weekly, maybe even daily, and yet most people, they may not even realize just how protected it is from global trade drama. And that is Visa, or ticker symbol V. Visa isn't just a credit card brand. It's the invisible network behind billions of payments around the world. And because it doesn't sell physical products or really depend on overseas manufacturing, it's one of the most tariff-resistant businesses out there. So what makes Visa so insulated from tariffs is basically its business model, right? It doesn't manufacture goods, move products across borders, or rely on materials that could be taxed or delayed. Instead, it makes a small percentage on each transaction processed through its network. So, whether it's coffee in Chicago or a hotel booking in Miami. And obviously they have those credit card interest fees too. That digital-first asset-light model means global trade tensions simply don't affect how Visa makes money. So let's take a second to highlight the stock's financial performance over the last 2 quarters so you kind of understand how they've been doing. So in Q1 of fiscal year 2025, Visa reported earnings per share of $2.75, beating expectations of $2.66. Revenue came in at $9.5 billion, above the expected $9.33 billion. And in Q4 of fiscal year 2024, it posted earnings of $2.71 per share versus the $2.58 expected, with revenue of $9.62 billion, topping the forecast of $9.49 billion. So yeah, they're beating their numbers. But let's bring in my AI assistant Tiara here to chime in. So Tiara, on a scale from 1 to 10, 10 being the highest, how likely is it that this stock will make investors money?
I'd give this a solid 9 out of 10. Visa's global moat and digital model make it one of the most reliable long-term trades on the board.
Now, those are some fair points, and those were so convincing that I actually placed an order to buy Visa myself right after I got done creating this video. Now, Visa, it shows how a digital payments network can really sidestep trade risk, right? But the next company here, it proves that other massive industries can stay completely untouched by tariffs if the model is built right, of course. Now, the next one is Exelon Corporation, or ticker symbol EXC. Exelon is one of the largest utility companies in the United States, supplying electricity and natural gas to millions of homes and businesses across several major cities. Its operations are deeply rooted in domestic infrastructure, which makes it one of the most stable tariff-insulated companies in the US market right now. So what makes Exelon tariff-proof is the fact that it's a purely domestic business model. It doesn't rely on importing, raw materials or components to deliver power. It actually generates the energy locally and then distributes it through US-based infrastructure. Utilities like Exelon, they provide essential services that people continue to use regardless of what's happening in the global trade environment. Now, in Q1 of fiscal 2025, Exelon reported earnings per share of 72 cents, beating expectations of 70 cents. Revenue came in at $6.12 billion, ahead of the estimated $6.04 billion. And in Q4 of fiscal 2024, it posted earnings of 59 cents per share versus the expected 56 cents per share, with revenue of 5.89 billion, topping the forecast of 5.74 billion. All right, so Tiara, your thoughts on this one?
I'd rate this a 7 out of 10. It's dependable and steady, but utility stocks don't usually offer huge upside unless you're playing the long game.
I tend to agree with Tiara here. I think this one will make you some money, but it's definitely boring, and I wouldn't expect any big gains anytime soon. But now let's shift from public utilities to something just as essential in today's economy, which is digital entertainment. Now, the next one is one that you know. It is Netflix, which is the ticker symbol NFLX. So Netflix is the world's leading streaming platform, delivering movies, shows, and original content to over 260 million subscribers. Its product is 100% digital, which means no shipping, no factories, and no physical supply chain whatsoever, which makes it one of the clearest examples of a tariff-proof business. Now, what keeps Netflix immune from tariff pressure is really the nature of its entire service. It distributes content over the internet, not through containers or cargo ships or anything like that. The company's entire business model runs on subscriptions and data delivery, meaning that trade policies and import taxes have zero direct impact on how Netflix operates or earns revenue. Now, by the way, if this kind of research-backed investing content really helps you kind of cut through all the noise out there, and there's plenty of it right now, make sure that you hit that subscribe button, as I've got more breakdowns like this coming to help you invest with confidence in the future. Now, back to Netflix. So in Q1 of 2025, Netflix reported earnings per share of $4.62, which beat expectations of $4.52. Revenue came in at $9.89 billion, slightly above the estimated $9.83 billion. In Q4 of 2024, it posted earnings of $3.92 per share versus the expected $3.72, with revenue of $9.37 billion, exceeding the forecast of $9.3 billion. So Tiara, go ahead.
I'm going with an 8 out of 10. Strong content and global scale help Netflix stay sticky, but rising competition adds just a little uncertainty.
Yeah, there is a ton of competition in this space now, but Netflix does continue to beat rivals, and I feel it'll stay that way. That said, streaming content across borders is definitely one way to avoid tariffs. But what if I told you that a company built around garbage trucks and landfills might be even more protected? This next one is Waste Management, ticker symbol WM. So Waste Management is the largest provider of waste collection, recycling, and disposal services in North America. Its operations are rooted in local contracts, domestic logistics, and long-term service agreements, making it a classic example of a recession-resistant and tariff-proof business. There's no international shipping, no reliance on foreign materials, and no exposure to global trade friction whatsoever. Everything from picking up trash to managing landfills happens within US borders for this company. That level of localization really shields the company from import taxes, supply chain issues, and trade policy shifts that could absolutely hit other industries hard, and frankly already has. Now, in Q1 of 2025, Waste Management reported earnings per share of $1.53, which beat expectations of $1.49, and revenue came in at $5.2 billion, just above the forecasted $5.17 billion. In Q4 of 2024, it posted earnings of $1.44 per share versus $1.40 expected, with revenue of $5.12 billion, topping the estimate of $5.09 billion. And Tiara, what are your thoughts?
This gets a confident 9 out of 10. Recession-resistant, tariff-proof, and tied to essential services makes it a quietly powerful trade.
Ooh, that was a bit of a surprise, but I love it. But do I love it so much that I bought the stock? Yes. Yes, I did. Now, some businesses, they keep the country clean, and others, they keep it connected. And this next one here does the latter, all while staying almost entirely immune to tariffs. And this next one is Verizon, ticker symbol VZ. So Verizon is one of the largest telecom providers in the US, delivering wireless, internet, and broadband services to over 140 million customers. Its entire operation is focused on domestic infrastructure, like cell towers, fiber lines, and data networks that keep Americans connected coast to coast. Now, what makes Verizon, largely immune to tariffs is that it has minimal reliance on imported goods or international logistics. Its core business, which is monthly service plans and data usage, is based entirely in the US. It doesn't need to, move products across borders to generate revenue. And most of its network investments are tied to long-term, domestically sourced infrastructure. So in Q1 of 2025, Verizon reported earnings per share of $1.21, matching their expectations. And revenue came in at $34.6 billion, slightly above the forecasted $34.4 billion. In Q4 of 2024, it posted earnings of $1.08 per share versus the $1.07 expected, with revenue of $35.1 billion, topping the estimate of $34.9 billion. So go ahead, Tiara, what do you think?
I'd call this a 6.5 out of 10. It's stable and pays a nice dividend, but growth is limited and debt remains a concern.
Interesting. So far, the worst one rated on the list here, but I think it's still a winner, at least in the short term as all this, craziness blows over. So we've already looked at companies that are powering our homes, connecting our devices, and managing our everyday waste. But what about a company that profits from something that even is more fundamental than those things, which is where people live? Well, the company is Equity Residential, ticker symbol EQR. So Equity Residential is a real estate investment trust, or a REIT, as most people call it, that owns and operates apartment communities across high-demand U.S. cities. With properties concentrated in places like Boston, New York, Seattle, and San Francisco, the company generates nearly all of its revenue from domestic rental income. Its business is about as localized as it gets, really. Equity Residential, it doesn't sell products, ship inventory, or rely on imported goods. It rents out physical space month after month to U.S. residents. That kind of simplicity makes it really naturally resistant to tariffs and even trade disruptions, even in crazy markets. So in Q1 of 2025, Equity Residential reported funds from operations of 95 cents per share, slightly ahead of expectations of 93 cents. Revenue came in at $731.2 million, beating the estimate of $726.4 million. In Q4 of 2024, it was 91 cents per share versus the expected 89 cents per share, and revenue reached $719.8 million, just above the $715.6 million forecast.
I'm going with a 7.5 out of 10. Reliable cash flow and strong metro markets help, but interest rate swings could shake the value.
Definitely some fair points there. So interest rates are pretty stupid right now, just as they have been lately in the last few years. But at least they have properties locked in and can really cash flow in the short term. Now, real estate, it shows how physical assets can really thrive without global exposure. But now let's kind of flip back to the digital world here. So this next one it's pure software, runs entirely in the cloud, and doesn't ship a single thing. And that company is Salesforce, which is ticker symbol CRM. So Salesforce is a cloud-based software giant best known for its customer relationship management software, or CRM platform. Its tools help businesses manage sales, marketing, service, and data completely online with no physical products involved whatsoever. Now, what makes Salesforce virtually untouched by tariffs is its digital-only business model. The company sells access to software, not hardware, and everything is hosted in the cloud and delivered over the internet to companies directly, which means that there's no shipping, no raw materials, and really no risk of import taxes interrupting the business as a whole. Customers, they subscribe, they log in, and they use it. Simple as that. Now in Q1 of 2025, Salesforce reported earnings per share of $2.08, beating expectations of $1.91, and revenue reached $9.22 billion, topping the forecast of $9.13 billion. In Q4 of 2024, it posted earnings of $1.78 per share versus the expected $1.72, with revenue of $9.11 billion, just ahead of the projected $9.06 billion. Tiara, what are your thoughts?
This one's an 8.5 out of 10. Strong fundamentals, sticky customers, and pure digital delivery give it major staying power in the tech space.
Now, fun fact, I actually sold Salesforce when I had it myself at roughly $215 per share years ago, and I'm still kicking myself a little bit about that. So I agree that this is a winner. Now, if you want to go beyond picking individual stocks and actually think like a millionaire during a trade war, which you should want to do, you should check out this video right here. In it, I actually break down the exact strategies that wealthy investors use to protect their portfolios and grow them when tariffs hit. So I'll see you over there.